Good day, fellow investors. For the first time on this channel, we are not talking about a Brazilian company, but a British one, British American Tobacco, which I've been following for the past more than 5 years. It's a global tobacco giant trying to shift toward reduced risk, so-called reduced risk products. It has very strong moats. It's strong brands, distribution channels. It's an addictive sector. And many regulatory barriers for anybody to compete. Management has a clear focus on dividend payouts and growth of dividends, debt reduction, and of course the shift towards the new product categories with actually pretty decent incentive structure for management. And from a valuation standpoint, the company is fairly valued. It has really strong cash flows and a fantastic business from the numbers side. So let's jump into it. So one of the leading tobacco companies in the world, right? So you have Altira in the US, you have Philip Morris International, you have BAT, right? Those are the publicly traded big ones. You have Imperial Brands, which is also a UK company, a smaller tobacco company, and then you have the Japanese tobacco and then the China tobacco. They sell tobacco products, vaping and nicotine alternatives. Recently, there's been a great uptick in the nicotine pouches. Philip Morris has the great Zins, and they are trying to compete there quite successfully, actually. They are trying to transition to that area, and profitability greatly improved actually from 23 to 24. Let's talk about Reynolds. So in 2017, BAT bought the remaining shares of Reynolds. They already owned 42%. They bought the rest with cash and BAT shares. For cash, they borrowed around $25 billion to complete this transaction. And let's talk about a bit more recent changes. They had a lawsuit in Canada, like many other like the other tobacco companies, but BAT had the largest market share in Canada. I think 40 something percent, while Philip Morris had like 30 something, and then Japanese tobacco 20 something. Basically, you have to pay the Canadian government for all the health issues tobacco's caused, right? For that, in their 2024 annual report, they booked a 6.2 billion provision. This is non-cash. This is just a provision. With that, all litigations are settled, and this, in the end, I think around 19 billion pounds will be all that has to be paid, not by BAT alone, but broken down by market share. So BAT is like 40% of that. It will be funded by ITCAN's cash and future profits. So the company, I think 85% of profits generated there will be used to fund this payment towards the Canadian government until you pay it off, right? It's interesting that they have a provision of 6.2 billion. Meanwhile, you don't see that for JT or Philip Morris. So my analysis for this is basically under their accounting, they just pretend it's not there. So with IFRS, BAT recognizes it, PMI doesn't. So my analysis is that all three companies got slapped, but the other two are pretending that they didn't. It's not the end of the world. Canadian business was a small part, less than I think 1% of BAT's income. And let's talk about 23. In 23, they booked a 23 billion pound impairment to their cigarettes brands. It's a non-cash impairment, so it doesn't affect their cash. It affected their goodwill. So they were amortizing their goodwill. Now they just like basically did a large amortization and impairment of their brands. On a segment breakdown, Let's look at the left side. You see the US being dominant, followed by Americas plus Europe, and then Asia Pacific, Middle East, and Africa with 21%. And on the revenue side, you see 80% combustibles. It was 81% last 23, and then you see new categories at 13.3. It was 12.3 just in 2023. The other two didn't change. Okay, let's talk about the moat of the business. Brand recognition, huge moat. You have these great brands, old brands, from the ages when cigarette companies could advertise openly. Of course, addiction economics. So the nicotine products have high consumer stickiness. They are price inelastic. I think their elasticity sits between, for developed markets, between minus 0.2 to 0.5. Basically, you increase the price by 10%, and then you will have a 2% to 5% drop in demand. So with declining combustible sales on the volume side, they still have higher earnings per share because they can increase prices. They have pricing power. Distribution chains worldwide, yes. Regulatory barriers, really important. Companies don't like regulation, but regulation protects giant companies from competition. It's not just true for tobacco, it's true basically for all industries. It protects companies already in there. And they are trying to develop moats in the new nicotine products, but the competition there is still up. Although if you would look at the 2023 numbers from profitability on new areas, so-called reduced risk, they were not as nice. In 2024, it's surprisingly good. I think it's double digit for most of them, finally. So I'm more positive than I was before on that. Okay, let's talk about management. So first priority was to deleverage after Reynolds. They did that, so from 47.5 to 37 billion today from 2018 to 2024. Also, the value of the pound is less, and like all currencies in those 7 years. So that's 47 is actually in today's money is way more. Diversifying into reduced risk products. Yes, I would like to note that Kenneth Dart, an offshore billionaire, has a 7.9% investment in BAT. I think around the 6% investment in Imperial Brands and like ownership of those companies. And actually on Evolution AB, I'm gonna make also a video later. He has a 20%. So his strategy is to buying these hated companies because they are cheap. Nobody buys them, so he can buy them like strong hated companies and then change around management a bit to be more commercial oriented and focusing on dividends and buybacks, cutting all the nonsense and focusing on the business. And in their dividend policy, you can also see that they have a 65% payout ratio of adjusted earnings. They pay out quarterly, and they are committed. They mention this multiple times. They are committed of sustainable long-term growth of their dividends. So year by year, they try to increase their dividends, and they did actually. Dividends plus buybacks together increased on a compounded annual growth rate of around 4% between 2018 to 2024. So that's not bad. And they already committed to 900 million buyback for 2025. So let's look at their incentive plan. And we can just focus on the right side here. Revenue growth, super good. Adjusted profits from operation. Well, usually I don't like adjustments. I like clear GAAP or IFRS numbers, but adjusting makes sense here due to their impairments and Canadian provisions. New category focus, great. And also it's good to look at the trend, by the way. Like they focus more on commercial today than they used to maybe a year ago, even from 25 to 30%. New categories growth, they reduced that. It's less profitable than the combustible business, so good to grow that, but there's a core business for you, and you can also see it here. They added climate. I mean, they are a tobacco company, so I'm not sure how they contribute other than daily operations. we'll see how that changes for this year with the political shift in the US and in general, given the Trump election victory. This is short-term incentives. Long-term total shareholder return didn't change. EPS better than proposed. I like to focus on EPS because then you have less shares outstanding with buybacks. So even if you would have dropping profits, if you buy back faster, then you have EPS going higher. Cash conversion rate, really important. This is a cash business. They don't deal with long receivables like some other industries. They have cash. New categories growth, smoke loss revenue. Yeah. These are all nice, and this addition I really like. So great. Use your capital as efficiently as possible. From a value investing point, if you have cash, first you want to look at how can I invest in the business at a good return. If I can't, I'm going to look at my share valuation. Is my company trading below intrinsic value? If the answer is yes, then you should buy back shares. If the answer is no, then you should just pay out dividends to the shareholders. Profitable investment, buybacks below intrinsic value, dividends. That's how you do it. On a CEO and CFO pay level, 6 million, 5 million. This is normal, not outlandish. Let's look at shareholder remuneration history. So you can see that they are growing. Their free cash flows are on uptrend. We have a dip in 24, but generally it's going up. Your dividends are going up. You have buybacks coming up. They are a solid dividend payer company with a solid business, low volatility business, low macroeconomic exposure business. So it's a nicotine product. It's addictive. People's gonna buy it. Let's look at margin of safety. From the valuation perspective, I always use 10% discounting on all the end numbers. If you use my discounted cash flow value, that's 47 pounds per share. For that, I use the 2% growth rate because the company is expecting 2 to 4% revenue growth. So I took the 2% and just plugged it into the model. It gives me 47. Although, if you expect the company not to grow, then you basically say that, okay, 2024 number is going to be all forever. That is 44 pounds per share value. And the 7-year average of these cash flows are 43. So you are kind of in the ballpark here, of course, because you don't have much growth here. So it's not hard to predict business like a high growth tech stock or other stock would be, where you are uncertain. Do I use 5, 10, 15, 20% growth rate for 5, 10, 15 years? Really hard to tell. For this business, it doesn't grow much. It goes with inflation. They adjust prices a bit higher usually than inflation because they have a pricing power. And that's it. Still some business metrics here. I didn't pick return on equity or return on investment. I picked return on tangible assets. So basically you deduct the intangible assets, the brands, and you see that this business doesn't use much assets, and they have brands. So on the assets they use, they produce massive returns. You can also see the free cash flow margins are massive. This is a proxy I use instead of earnings. I use free cash flow, huge margins, but you can look at it as like profit margins. They have relatively, manageable debt, especially if you compare it to US companies in general or US peers. They usually have negative equity. They don't. The BAT doesn't. But actually debt to equity doesn't really matter for a company like this. What matters is their coverage ratio. Do they generate enough cash to pay their debt? And then you can see they have a relative low cost of debt in the UK. Of course, it's up compared to a 7-year average because we had really low and negative interest rates. But they have a really low cost of debt. On the other side of the business, let's jump to the number 2 here. Free cash flow relative to cash flow from operations, 95-96%. So the capex they spend is like 5% of their cash from operations. They don't have to spend a dime to keep the business running. So if you think about a railroad company, they have to spend like all of the money to just keep the business in place. So just to tread in the same spot, not moving forward, not spending on growth yet. But this business doesn't have to spend anything. And of course, there's an ESG discount, because if you look any bigger funds like description, they say they don't invest in coal, or they don't invest in gambling, guns, and of course tobacco. They don't buy it. So institutions, generally big insurance companies, don't invest in this business because of ESG, which means less money is chasing these companies. So generally they will have a lower valuation, which is weird because they are not weird, understandable, but they are a low volatility business. That's why they can lever up. They are low volatility. So valuation should be up, but no, because not a lot of money comes into this business to buy it up. Hence you have types like Gannett Dart come in and buy large chunks of the company. We talked about this, yeah. And of course there are risks. Every business has its own risks. You have regulatory risk. I would argue there is regulatory opportunities today. The company mentioned that they are working with the Trump administration to try to block black market products, vaping and tobacco alternative products coming into the market. If you listen to the February earnings call, the CEO mentions they are working with Australia, to lift bans. Since I think they were talking about vapor products, because when a government, and I would really like to emphasize this regulatory risk, because people say that, oh my god, they're gonna just ban tobacco. No, if the government bans something, it doesn't disappear. It just goes underground. It's gonna be a black market. It's not gonna get tax revenue. The government doesn't get tax revenue. It will have more costs of policing that area. You will have more health issues coming from unknown substances. Multiple countries tried to, or actually banned it, and then had to reverse it. And some underdeveloped countries, like underdeveloped tax structure countries like Pakistan, is I think having like 10% or more of their revenue from tobacco taxes. So they are reliant on this product, and if they put taxes even too high, so like it would be a punishably high level of taxes, then at one point people are just gonna go to the black market. So that you can ban it, and you can tax it high, but you cannot like totally put the taxes at like 90%. Otherwise it's just like being banned, and then people go to the black market to get it. Declining smoking rates, that's a risk, but as said, they have such a pricing power that if prices if inflation pushes prices in general up by 3%, BAT increases it by their products by 5%, and then people still buy it because it's an elastic addictive substance. And alternative products, reduced risk product success, that's a question, but if you recall, that's a fraction of their segments, and they also show improvements there compared to last year, to 2023. In 24 they showed improvements. So that would be it for BAT. Our table is expanding here. You can see, you can pause the video and then look at all the KPIs here. I'm not gonna run through them. I think BAT has an upside using my method of 10% discounting and 2% growth at current cash flows. I think this is a wonderful business, but of course it's tobacco, and you have to think morally if it's okay or not okay for you, what you put your currency in, your money, your current, your energy, your ideas. maybe it's not for you, and it's completely understandable. Going forward, I'm going to keep the theme of picking companies non-US specifically. I find them cheaper in general from a valuation perspective. This is also true for British American Tobacco. If you compare it to Philip Morris, it's much better priced, and the two companies are really similar from a numbers perspective. If you like this video, please comment what should I pick next, and like it, and see you in the next one. I hope you enjoyed. Thanks. Cheers.